Welcome back, students. We're back to revenue recognition, and this is video 2 on revenue recognition. I'll pick up where I left off a few minutes ago for me, maybe a while later for you. But we're going to start with gift cards. And key thing to remember with gift cards is when you sell a gift card, you debit cash, you credit what? Deferred revenue or unearned revenue. Gift cards are unearned revenue. They're just a liability. We don't recognize any revenue at the point of selling them. Now, when they are used, we're going to debit deferred revenue and credit sales revenue. Your book talks about, right in here, revenue is recognized when you no longer expect the gift cards to be used. You have to be careful of that. That varies by state law, actually. In Texas, most gift cards that go unused, the money actually escheats to the state. So that may or may not be true. Most companies are pretty good at figuring out ways to get that revenue. And so what they commonly do is after some period and the gift card hadn't been used, say after a year, then they start to charge a monthly maintenance fee and chip away at that balance until it's all gone. But anyway, that's all there is to gift cards. Now, next up is disclosure. And if you were in class here with me, I would say, okay, when it comes to disclosure, we disclose what? And I would expect you to all reply, everything. And the same is true here. You always, with revenue recognition, want to disclose everything there is to disclose. Right here, they talk about the contract liabilities, and we're going to get into that more with long-term contracts in a little bit, but you disclose everything that's going on, the nature of the contracts, the nature of the revenue, the way it's recognized, all of those kinds of things. Okay, let's move on down. Now, accounting for long-term contracts, that is a big topic. That's going to take me a while to discuss. I don't expect to get through it all on this video since these videos are limited to 15 minutes based on my software. But we'll go as far as we can, and then I'll finish with the next video if necessary. Now, accounting for long-term contracts, there are basically two ways to do that. Most long-term contracts, and quite often you hear the term long-term construction type contracts because those are the most common ones we run into. Those are long-term contracts for building buildings or building ships or building airplanes. But notice the word building is usually in there. You could get into other long-term types of contracts, but this is primarily focused on construction type contracts. And the first thing you'll notice here in step 2, identify the performance obligation. Now, let's say you're a construction company and you sign a contract to build a high-rise office building for some big company. Now, reality is there are a lot of things that go into that. And they talk about right in here, there are a lot of products and services that are capable of being distinct, but they're really not separately identifiable because the seller's role is not to install a foundation and install plumbing and install electrical and frame the building and put up the siding and put up the bricks and put in windows and put on the roof and all those things. What they signed up to do is build a building. So usually there is only one performance obligation, and that is to complete the project. So usually those contracts qualify, have a single performance obligation you see here, and they qualify for revenue recognition over time. You have milestones built in, and as you achieve certain milestones, you're able to bill the customer and recognize revenue. Now, billing the customer and recognizing revenue are totally separate things. We can recognize revenue without billing the customer. We can bill the customer without recognizing revenue. Recognize that those are totally separate. Okay? In step 5, we recognize revenue when or as each performance obligation is satisfied. Again, there's probably only one performance obligation, and most long-term contracts qualify for revenue recognition over time. Often the customer owns the seller's work in progress such that the seller is creating an asset that the customer controls as it's completed. You see the other, often the seller is creating an asset that is customized for the customer so that the seller has no other use for the asset and has the right to be paid for progress even if the customer cancels the contract. Both of those are situations where the contract calls for revenue recognition over time. Now, historically, we have referred to the two methods as the percentage of completion method and the completed contract method, the two methods of recognizing revenue. Those still exist, but the names have been changed. Percentage of completion method is now referred to revenue recognized over time. Completed contract method is revenue recognized at a single point in time, and that is upon completion of the contract. Now, with revenue recognition over time, or the percentage of completion method, basically, remember, when we're recognizing revenue over time, we have to determine some method of identifying the percentage of completion, how much of the revenue has been earned at any point in time. Now, that can be based on a measure of outputs, and often is. So if we were signed a contract to, make 10,000 widgets, then the number of widgets we output would be the measure of completion of the contract. Now, with building a building, it's not really easy to measure the output. So quite often what we do is based on measures of inputs. And that method is usually referred to as the cost-to-cost method. Now, what the cost-to-cost method does is it looks at how much cost have we expended, how much cost do we expect to expend for the entire project. We get a percentage of costs already expended to costs expected to be spent. And then if that percentage works out to, let's just say, 60%. Let's say we have a contract and we're expecting to spend $10 million and we spent $6 million. So we have spent 60% of what we expect to expend. And let's say that the contract is for $15 million. So 60% of $15 million would be $9 million. So we would recognize $9 million of revenue. So that's the cost-to-cost ratio, or the cost-to-cost method. Total cost spent to date compared to total cost expected to be spent for the entire project gives you that percentage of completion. And we multiply that times the total revenue for the project, and that gives us the amount of revenue we recognize to that point. Okay, now we'll get into the specifics of that in an example a little bit later, but right down here they talk about accounting for a profitable long-term contract. And that's what we're going to spend most of our time with. Accounting for an unprofitable long-term contract actually is kind of simple, because as soon as you recognize the project is going to be unprofitable, you recognize the entire loss in that year. Now, as long as you think the project is going to be profitable, you continue to recognize revenue over time. Even with a profitable long-term contract, you may have individual years where you show a loss. And usually that happens where your estimate of total cost jump. So we have an example later that shows you that. I'm not going to spend a lot of time with that. But in our example a moment ago, we estimated we were 60% done with the project. And so we recognized $9 million of the $15 million revenue. And so if this was the first year, we spent $6 million. We expect to spend $10 million, and the project's worth $15 million. So we spent 60% of what we thought we were going to spend, and we are 60% of the way done. And so we recognize 60% of the $15 million revenue, $9 million. We would have a gross profit for that year of the $9 million revenue minus the $6 million in costs, or $3 million. Now, let's say in year 2, we spend another $4 million. So that gets us to $10 million. But now all of a sudden we are estimating that it's going to cost $13 million to complete the project. So what do? Well, we look at it and say, we've recognized $3 million in gross profit, but now we think there's only going to be $2 million in profit. So we're going to have to recognize $1 million in losses. Now that's a change in estimate. So we do not go back and restate previous years. Instead, we just adjust it in the current year and in future years, currently and prospectively. So anyway, that's the concept of a profitable long-term contract, an unprofitable long-term contract, and a profitable contract where you may have individual years where you recognize a loss. Now here, you see an example played out, and this is the cost-to-cost method, all right, here. But we have a construction project. We're hired to build an office building for $5 million. Year 1, we spend $1.5 million. So our cumulative expenditures at the end of year 1 were $1.5 million. We expect to have to spend $2.25 million more to finish the project. So our total estimated cost is $3,750,000. We can get then our cost-to-cost ratio, our cost incurred to date compared to total expected cost, of 1.5 million over 3.75 million. That gives you 40%. Now we're estimating the total project cost $3,750,000. The revenue will be $5 million, so we're estimating $1,250,000 profit. We multiply that times 40%, and that's going to give us gross profit this year of $500,000. Now we'll see that played out later on. The next year, we spent $1 million that year. We had spent $1.5 million in previous years. Gives us total expenditures of $2.5 million. We're now estimating total expenditures for the project of $4 million, with $1.5 million more to go. So now we are 62.5% of the way through. We're expecting $1 million in profit. $400 million total cost compared to the $5 million contract price. So in that year, we would recognize revenue to get us to the point of 62.5%. Okay, my time is running out. I will pick up there with the next video.